Hey, you guys. I've got my friend Andy Pickup here, publisher of the Wall Street Transcript. Hi, Andy.
Good morning.
Thanks for coming in again.
Yep.
We've got a great fund manager interview that Andy's going to share with you from this week's edition of the Wall Street Transcript. I really like this guy, and I bought both of his funds in my personal accounts. Who do we have, Andy?
Okay, we have Ted Kellner of Fiduciary Management, and you're right, it's a great interview. We interview a lot of mutual fund managers, professional investment managers, and this guy's a really good guy, down to earth, sensible, and his returns are stupendous, aren't they?
I love this guy. I thought exactly what you said, right? I like how he explains his approach, right? He's very sensible, and his returns, he's beaten the S&P. And he's a very good choice for a safe haven in a tough market.
That's right. So he has these two funds, a large cap fund and a small cap fund.
They're FMIMX and FMIHX. And I actually bought both of them.
And both of them have been beating their comparable indexes, right?
Right.
The large you'd compare with the S&P, the small with the Russell.
Here's his small cap. He said it's 28 years old. It's a small to mid cap, actually, right? And they've only had 4 negative years in those 28 years, and they said most of the times they're compared to the Russell, right, which is sensible, right? It's a sensible benchmark.
That's
and
right.
He said their client portfolios over that 28 years are up 53%, and the Russell's down 53%. Then their large cap is 8 years old, and he said they've only had 1 negative year, which was 2002, when they were down 13%, and the S&P was down 22%, but that their aggregate return for those 8 years is up 112% versus the S&P being up 14% for the same time period. So he's really outperformed against the benchmarks, right?
Yeah.
And he said, they're not going to, what does he say? Let me give you his quote, which will be much better than mine. He says, when you look at the year-by-year record, we really add value in the down markets. We do reasonably well in the up markets, but with a value approach, we shouldn't shoot the lights out in the up markets. We do all right, but the value added comes from the outperformance on a relative basis in the down markets and not getting buried when the inevitable bad markets come along, and that's exactly what he's done.
That's right. So let's talk a bit about his investment style. He's looking, they are a value fund. They're looking for stocks that are going to do well in the long run and that are off temporarily, basically, right? He's
right.
Looking for just blips down where he says 25-35% off, but essentially strong long-run franchises
right.
that could do well on a return on invested capital basis.
He says they're very careful to try to avoid value traps.
Yeah,
where he feels there is something that they're just out of favor, but unreasonably so.
That's right. And they look very carefully at management too, which we always like from any fund manager because we believe management is about the most important thing too. And there's a couple of things. So he's looking for solid managers that are looking to build the company, not indulge in gimmicks, right?
Right.
And he's a bit suspicious of certain acquisitive companies as being
right.
gimmickish.
He'd rather see it organic than just acquisition for acquisition's sake and building up the smoke and mirrors of acquisition.
That's right. And he's also looking at compensation. He's really in favor of longer-term incentive compensation like stock ownership and suspicious of short-term incentives like stock options where there's often a big asymmetric risk incentive to take risk, to make
right.
the options worth something over 2 or 3 years. If it works out, great. If not, get out.
Lost anything.
Yeah, exactly.
Right. Yeah, good, sensible approach, and it's worked out very well, and that's why I've put some of my own money into it.
Yeah, no, he's great. Let's talk about some of the things he likes right now. He certainly seems to be oriented in some of the sort of consumer durable areas, which, surprise, surprise, have been beaten down, which is kind of exactly his approach, right?
Right.
That in his case, these are long-term successful businesses that have just been beaten down a bit in the short term. So he likes some stocks like Ethan Allen. He likes Best Buy, which is really a consumer durable business. There's some construction stocks like Watsco, which is a big HVAC distributor.
We webcast Watsco often for our sensible banks.
Yeah.
For Baird and Blair. Right.
And Beacon Roofing, which again is a play that really is almost against new construction because a lot of their business is in replacement roofing.
Right.
Yeah. He likes Walmart. He likes Family Dollar.
And lists his reasons why.
That's right.
And he's very consistent in these.
That's right. Like Walmart, he was very into the stock when they were beaten down over, political issues, healthcare issues, a lot of stuff, a couple of years ago, really, that he felt didn't particularly reflect the success of the business.
Right. I loved this guy. I loved the smart but common sense approach.
Yeah, and it's worked out for him.
It's kind of saved the flash, and it's worked out really well. An extraordinary track record.
Yeah.
And another great interview from the Wall Street Transcript.
That's right. We love this guy, and we love interviewing people like him.
Yeah, well done. Thanks very much, Andy.
Thanks.
Guys, you can find more of these at WSMCO.com. Thanks.